All right. Hello, everybody. Welcome to the 7-Minute Workshop, during which we chat with experts to break down complicated or timely topics that affect your business. And we do it all in just 7 minutes. That's shorter than it takes you to order your breakfast burrito on a Sunday morning. Or in my case, maybe, little past morning. If you've been following along our superhero new age of growth journey, if you've been following that, today we unveiled the newest member of the superheroes of finance, Intangible Girl. So check that out on our website and our social channels everywhere. Last week, we discussed intangible assets and how to account for them. And today, we're covering a topic that stems from that: how to value goodwill. I'm about to bring out our senior product marketing manager and resident expert on the topic, Scott Beaver. But before I do, a quick reminder: if you have any questions throughout today's discussion, you can ask them in the comments and we'll get to them at the end of the conversation. And don't forget to tell us where you're tuning in from and drop a hello. We know that you've signed on from all parts of the world. Last week, we got people, I don't even know how many countries, like all over, pretty much every continent covered. But we'd love to send out a ciao or a ni hao right back at you. I'm in the Middle East. We welcome you from all over the world. Now, please join me in a warm virtual welcome from the United States for Mr. Scott Beaver. Hi, Scott. Thanks for joining us.
Hi, Fritz. How you doing?
I'm great. We're going to talk about, I love this, goodwill. It just feels so good, but
Yeah, it
the
does.
way we're going to talk about it, maybe not always, I don't know. Why don't we start by a good, solid definition? What is goodwill?
So goodwill can really be thought of in two ways. Sort of the textbook definition from an accounting standpoint is that it's the price premium that you pay to acquire a company, and it represents that portion of the overall acquisition price that is more than or exceeds the actual value of the assets less liabilities. So every company's got assets and it's got liabilities. That's sort of the net value or the asset value of the business. So goodwill is whatever I pay over that to acquire the company. And so that's from an accounting standpoint. And that's how you'll see it on a balance sheet, just as a dollar figure. But it's really more than that, because from the standpoint of the company doing the acquisition, it's really it represents the value that's inherent when they're in a business, but not really associated with specific assets. For instance, those are characteristics like the market position, the business model, the management's overall strength, the company culture, reputation, et cetera. And these are the qualities that really differentiate one company from another. You can have three companies in the same industry with very similar assets, but one is going to be maybe better than the others just because maybe they're more innovative, maybe the culture is more engaged with the customer, and so that's really what goodwill attempts to capture. It's not an easy thing to do, but that's really what goodwill represents. That it's an intangible value, but it's certainly important to the overall value of the business.
So it's how we're placing value above and beyond, the things we know what their actual value is. It's what we think the value of the company could be for us, the acquirer.
Yes, exactly.
Okay, so you mentioned this a little bit. Last week we discussed intangible assets. How does goodwill differ?
So goodwill is a special type of intangible asset. It's broken out again on the balance sheet. You'll have your fixed assets, both the tangible and intangible, and then you'll have goodwill. But it is an intangible asset because it can't be tied to anything specific. What really makes it different is that it's more or less considered a permanent asset, whereas most long-term assets, even indefinite life assets, can be, are written down over time. Goodwill isn't necessarily treated the same way, and we can talk about that in a little bit if we talk about some of the accounting, unique accounting rules around goodwill. But that's what really makes it different.
Okay, well, hopefully we'll get there. So back to this issue of value. Does goodwill affect the value of the company making the acquisition?
Technically, there's the technical answer, and then there's sort of the market answer. Technically, no. So an acquisition is really just a transfer of value. For instance, if I purchase a company with cash, maybe I'm Oracle and have $80 billion in cash laying around.
Just as an example.
As an example. So if I do that, it'll show up on my balance sheet as a decrease in current assets, which are cash, and an increase in non-current assets. So from a pure accounting standpoint, it's a wash. The increase and decrease offset one another. And so, as the acquirer, the net for my balance sheet is the same. But so that's the technical answer. But if my company's publicly traded, for instance, and maybe the market really likes the acquisition, then my share price could go up. And so that's going to increase my market cap. On the other hand, if I'm a private company and I want to be acquired, if a potential suitor looks at me, they're going to see that goodwill on my balance sheet, and they may reassess the value. They may increase the value of my company based on what they see I acquired, or the combination of the two companies may be greater than the sum of its parts. So so technically the answer is no, but in reality, there are impacts of any acquisition.
So let's go back to the acquisition and how value of goodwill is determined. You called it a kind of a intangible asset, but at some point you got to put a tangible number to it.
Right.
How does that happen?
Yeah, there are a couple of ways. The first is to start with the net asset value. And if a company has been around a while, they're break even or really not profitable at all, and then the only thing I really want to acquire is the assets, I'm not getting anything from the reputation or their customer base, then that's maybe where I start with. I'll probably hire a third party or potentially hire a third party to come in and assess the fair market value of all the assets the business owns, whether they're tangible or intangible. And from that, I'll also have to subtract the value of the liabilities. What's the outstanding debt, and that's how much the fair market value, if you will, of the business is. But owners want more than that, obviously. So they're not going to sell just to get out what they've got invested. And for a company that's growing, profitable, or that looks to have a very strong future, that's where the goodwill comes in. And so I'm using a term that's called the enterprise value, which is everything over and above that, the net asset value. And that's really where my goodwill comes into play. And I'm trying to figure out, as the acquirer, what do I think the future revenue, the value of the future revenue of this business is? And typically what you'll hear, how you'll hear this expressed is as a multiple. It may be a multiple of earnings. So, the companies in certain industries maybe are getting a 3-to-1 multiple on earnings, or a 5-to-1 multiple on earnings. Might be expressed as revenue in some industries. In the software industry, frequently you've got companies that aren't profitable, but they're growing and they got really interesting technology. So they may be, valued at a multiple of revenue. And then another one that's really common is just to base it on EBITDA, because, that's seen as, and that, for those that don't know, that's earnings before interest, tax, depreciation, and amortization. In addition, rather than pure earnings, EBITDA is looked at as there are certain aspects of taxation, for instance, depreciation, et cetera, that aren't really under the control of management, or that management has less control of. So EBITDA is looked at as a better predictor of future earnings potential. But really, that's what you're looking at. You're trying to assess the overall value of a business based not just on its assets, but what you think you'll be able to do with that business. And some of that is based on past history, but a lot of it is based on, again, things like the culture of the company, how innovative they are, what their reputation, maybe some of their customers, if they have really tier one marquee customers, that sort of thing.
So what happens if over time you realize the value of goodwill was overestimated?
Yeah, so there have unfortunately been numerous examples of that. I think it was in 2000, maybe in 2012. Anyway, at one point, Hewlett Packard had to take an $8 billion write down on its purchase of a company called Autonomy, because they didn't really do their due diligence well enough, and they discovered some serious accounting errors, or outright fraud on Autonomy's part. So it does happen. Under U.S. GAAP, companies are required to assess the value of goodwill. Like I said, it's generally considered a permanent asset. There's some special rules for private companies, but it's generally considered a permanent asset. So if I acquire a company, I've got goodwill, put it on my balance sheet, and it stays there unless something happens that affects the value. And this is what's known as a triggering event. The COVID-19 scenario is one example of that. So with a triggering event, it causes me or requires me as a company to reassess the value of the goodwill on my books. For public companies, I not only have to reassess the value if there's a triggering event, I also have to reassess the value at least annually of any goodwill that I've got on my books. So there's a lot that goes into it. There's multiple steps and a lot of things that I have to consider. But basically, I'm saying is the carrying value on my balance sheet of this asset, goodwill, that's associated with my business, is it still above the value? I mean, or has it fallen below the value of what I could sell this business for today? So maybe I acquired it, in HP's case, I acquired it for several $1 billion. I think it was 20 billion maybe, but several $1 billion. And after a few years, they realized they overpaid. Now, instead of having a business that's 20 billion, I've got to take 8 billion off of that. So, in that case, the triggering event was sales weren't growing. They weren't generating the revenue that they thought. Now, it's slightly different for private companies. Private companies have two options. Number one, they aren't required to review or reassess goodwill on an annual basis like public companies are. They only have to do it on when there's an event, a triggering event. In March of this year, FASB, the Financial Accounting Standards Board, released ASU 2021-3, which basically says if you're a private company, not only do you not have to do this annually, but you can do it at the end of a reporting period. So you don't have to do it when the event happens like you would as a public company. You can wait till the end of the quarter, or if you only generate financial statements semi-annually, you can wait 6 months if you need to. So that's one difference for private companies. Another big difference is that if you're a private company, you can actually amortize the cost of or your investment in goodwill over 10 years on a straight line basis. So if I'm public, it sits on my balance sheet until sold. If I'm private, I have that option. I can write it down over 10 years. So that's kind of where the rules are a little bit different.
Got it. I want to open it up to some questions from the audience. For those tuning in, if you still have questions, please keep commenting, and we'll do our best to say hello, to answer as many questions as we can in the time we have left. I want to go back to these accounting rules for this first question, Scott, is are the accounting rules for goodwill the same as for other intangible assets?
No, they're not. Again, primarily because for private companies in particular, you can write it down over 10 years on a straight line basis. But for public companies, you can't. So that's a big one right there. Certain intangible assets have different rules. All intangible assets are amortized, but goodwill is treated specially because there's that minimum of an annual review. And if you're reporting goodwill as a public company, it's always going to stay on your books unless you happen to sell the business. One thing I should say about that: so goodwill is recorded at a divisional level. So if I'm a company, I acquire another company, the goodwill associated with that asset that I've acquired sits at a divisional level, not at a corporate level. So the only way as a public company I ever eliminate that goodwill totally is if I sell that division. So it's going to stay there, even if it's impaired and I write it down, it's still going to stay on my books for forever unless I happen to sell that division.
and sorry for if I'm confused about this, but if you straight line amortize it over 10 years, at the end of that 10 years, you still have to do what?
Nothing. You've basically written it off. It's just amortization
Okay.
is similar to depreciation, only amortization is used with intangible assets. So if I pay, $1 million, straight line amortization, take off $100,000 per year. By the end of the 10th year, there's no longer any goodwill value on my books.
Got it. Next question is, today was originally tax day. Does goodwill have any tax implications?
It can. First, let's deal with private companies. So in certain jurisdictions, goodwill amortization is tax deductible, just like depreciation would be, or any other form of expense amortization. So I treat that as an expense against revenue, and it gives me, it reduces my taxes. But that's only if I'm a private company and I've elected the option to amortize the value of goodwill, and if I happen to be in one of those jurisdictions, and they change, so I can't give you the current record of those. From the standpoint of a public company or a company that's not doing amortization, then it only affects taxes in two instances. One, if there's been an impairment, and then two, if I sell that business. So an impairment is a write down in value, but I can only take that value record that value as a loss if I actually sell the business. So until I sell the business, it's what's called an unrealized loss, and it doesn't affect my taxes at that point.
One other question I think is, there have been a lot of acquisitions where, you kind of referenced, buying the assets, but in the case where you're buying a company for its IP, maybe it's just their patent portfolio or whatever, are there different considerations that go into the valuation of goodwill in that case?
Yeah, it's, because goodwill is still somewhat subjective, there's always going to be the expectations of the owner. How much are they willing to sell for? And, how much am I as the acquirer willing to pay? I'm almost always going to have some premium unless the company is, unless there's a fire sale, basically, or the company's going out of business and I'm just getting the assets. But, the real difference, the real issue is whether it's IP or tangible assets isn't really a big differentiator. I mean, I'm still going to have to value those assets, the fair market value of those assets, and I'm going to still pay some premium. The bigger issue is if I'm able to acquire the assets at less than market value. In that case, it creates a situation called negative goodwill. It doesn't happen as frequently, but it can happen again when there's sort of a fire sale. I'm trying to stave off going out of business, and so I'm buying the company's acquired for less than market value. That's negative goodwill, and that's actually recorded as a gain. So I actually can wind up paying taxes on the acquisition because I've recorded a gain on the asset.
I feel like that should just be called badwill instead of negative goodwill, but that's just
the accounting terms aren't always as straightforward as you'd like them to be.
It's like a double accounting way of negative goodwill.
Yeah.
Well, that is all the time we have for today, Scott. Thank you so much for joining us and sharing your wisdom with our audience today.
Hope it was helpful.
Thank you. And as always, a big thanks to all of you for tuning in. There's always more where that came from. We'll be back in a few weeks with another 7-minute workshop on April 29th. We'll be diving into the omni-channel experience, going beyond the buzzword and into some KPIs to track, tactics to implement. So we will see you then.